you have to look at where opportunity areas are to increase NOI because your valuations for doing anything, whether it's leveraging into other things or leveraging into other assets or optimizing the eventual divestiture of that asset, will all be affected by how you attend to NOI.
Jason, what first drew you into real estate?
Well, when I look back, I essentially didn't want to recreate the wheel every month. I wanted to essentially focus in on um, assets that were essentially revenue oriented, and essentially ones that were leverageable in terms of point of entry, that were essentially able to be optimized operationally, and then gains to be had upon the exits. So whichever real estate class that applies to, of which it is essentially all of them except for land, you're dealing with the main components being leverageable entry. You're talking about rental optimization, rental appreciation over time. You're talking about net operating income optimization in whatever kind of operational uh, aspects you look to bring efficiencies to the every asset or every building or every property in question. And what goes hand in hand with that is the valuations then are based on NOI as a major part of the assessment, and you derive much higher values when things are optimized, and your exit points or your holding points for leverageable profit taking to move to other assets is there, as well as exits are optimized as well. So with all that in mind, it just seemed to be a very interesting across asset investment class to be engaged with, that was a short, medium, and long-term oriented.
So, do you think people are more focused towards NOI? Like, do they care about NOI a lot, or it's like mostly they care about the location?
I think if you're growth oriented rather than, let's say, people that are just not so much focused on staying on the cusp of where the market is, then you have to be concerned about where NOI and the operational guts of your building or your buildings or your entire asset portfolio. Each one has to be looked at individually. You have to look at where opportunity areas are to increase NOI because, again, your valuations for doing anything with that particular asset, whether it's leveraging into other things or leveraging into other assets, or optimizing the eventual divestiture of that asset, will all be affected by how you attend to NOI rather than staying stagnant and perhaps not keeping up. A lot of landlords and owners have had some negative experiences when they're not keeping up with their rental values, no matter what the asset class is, because then you're in a catch-up game unless you have inherent turnover of your residents or your lease occupant or what have you, and you're always playing catch-up, except for those turnover events, because you only have an incremental kind of level of legislated increase you can impose on an annual basis, typically in most jurisdictions, and that limits you, and you often end up playing catch up with a long term tenant until turnover occurs.
You're right. So, did you always wanted to join real estate, or like, what if you were not? Uh, if you get a chance to be somebody else or to do something else, what would it be?
I've always had an inkling in terms of the direction of where tech is going and where tech can be integrated into a lot of conventional investment asset classes and mechanisms. I've always been intrigued with how tech can be mechanized, not to benefit other tech operation per se, which a lot of tech is built upon. But I'm more engaged and interested and would have been inclined to go down the tech route anyway, I would imagine, if it wasn't real estate, because a lot of the aspects of tech really intrigue me in terms of how it can integrate across many disciplines, many domains. And it can also, you can leverage tech to do big things if you are so inclined.
You're right. So, what was your first job in this space when you started your career?
Well, essentially, it was as a business analyst. It was, and there was a business brokerage component to this operation. So we had to essentially find the businesses, evaluate them, go through all the financials, do a lot of analysis, and essentially position that particular business almost like real estate does for a property-based product. You had to do this for a variety of industry vertical businesses. So you essentially had to attribute value to that particular asset, being a business, an operating entity, and essentially market it to potential acquirers, potential larger fish that would eat the smaller fish, if you will, in their same industry or different industries. So it was a good window into how businesses would also include land and building. And so those components often worked hand in hand in terms of land, building, and business. And it gave a window into all of those components.
Great. So, what made you decide you want to do something of your own?
I've always had that nature. I've always had the indication that when you do your own self assessment, you kind of see where your strengths are. Uh, Mine have always been, in my estimation, assessing a certain scenario and seeing what other people don't see. I often will assess and analyze. How do you optimize um, this particular asset or this particular situation, or how do you make this a win-win-win scenario for all the stakeholders involved? I believe I've always had a knack for um, that type of self-actualization when you do your own self-assessment. I always felt that um, operating alone with a hub of key people, go-to people in terms of who you delegate to, was always a very strong scenario, rather than more of a corporate environment where everything's so diluted in terms of delegated work activity. It's kind of innocuous in terms of what the everyday or every week goals are um, towards the company benefiting, et cetera. I've always been an advocate for you put the work in, you bring strategic skills and abilities, and you should be able to optimize what it is that you as an entrepreneur have brought forward. And if it's something that you can create a win-win-win for all stakeholders at all times, that's a true entrepreneur in my books.
Very well said. So, what was your first deal like? So, how was the experience and what did it taught you?
Right. So it was an old lady that owned this multifamily building. Uh, and I remember actually in the assessment of what's best use, because we often talk in real estate about what's best use and things of those types of acronyms and names. So the best use for this particular site was had a few different aspects to it. It was a multifamily on a large parcel. And so I saw a lot of upside in terms of the short, medium, and long term of this particular property. It was a well leveraged purchase. We uh, looked at it, the broker and I, and essentially assessed that the best kind of entry point would be to get high LTV or loan to value uh, on the building in terms of having its revenue apply to the financing component in terms of being able to achieve high ROI. And that's one of the benefits to revenue oriented properties, is that you can always, of course, utilize the revenue component to optimize your LTV. And then we negotiated a short term second take back, vendor take back, we often call it, or seller financing. And so it was a well leveraged deal that moved forward. It turned into a 30-plus-year hold while we had the opportunity to add laneway housing, additional apartments, and whatnot on the same site. And the benefit at the time, it was early on in my 20s, it was a place where uh, the family could stay in one of the suites, and then after a year, move out, acquire another single family type of oriented property. But it was always a long-term hold with a lot of long-term memories captured in that. But I would always suggest that one area to start well. A lot of people think of the white picket fence in terms of single family as being your first property to own. I would always suggest that you should always look at something that you can position very well for a long-term hold, or at least a medium-term hold. Have your own occupancy in it for a short time, and then transfer out and have it as a sole asset over time.
What was the toughest market you lived through, and how did it? How did you handle it?
Well, toughest market I think often was I guess in the 80s I would have been too young. I'm not that old, not that old yet, but I would have only been a teenager at that, or yeah, late teenager at that time. But I would say COVID was pretty tough in terms of, and I'm sure a lot of people would have the same experience. Just from an institutional point of view, a lot of the changing thresholds from institutions, whether it's insurance, your insurance companies that are essentially with you on various assets and various properties, they were changing their profiles, changing their benchmarks. The lenders were changing their profiles and changing their benchmarks in terms of what they were wanting to keep in their portfolios moving forward. So I think COVID really presented a lot of challenges, and I think a lot of your viewers, a lot of your patrons would essentially look at that if they really put a lens to it, and would actually agree that a lot of the institutional pressures that were put onto private owners or portfolio owners put a lot of pressure from a variety of different ways, and it put pressure on tenancies, retention of tenancies at the values that you wanted to retain, because there was a lot of fluctuation, as we all remember, in terms of everybody's individual lives. They had to re-examine their own housing. They had to re-examine their own affordability ratios, et cetera. So I would say right down the line from top to bottom, all the way from 2020 to all the way through some remnants even now that continue, because those benchmarks have been institutionally placed, and they still affect people that are long-term owners or people coming into the market in the last few years or now. So it's definitely more expensive. You have to get around more legislation, more protocol, um, more risk-averse nature from banks, insurance companies, et cetera, that are critical partners in asset growth. So.
What did you change after that? Like, if anything happens just like that in the future, so what did you change to handle that kind of situation?
Well, I think the time at that time was not everybody thought they'd ride it out, but I think if you're positioning for sale, it was also a challenging time to position for sale. It was a challenging time to position for refis as well. LTVs for new bank renewals were very challenging, as well as renewals for existing renewals. Everything, all of those ratios changed, and it affected people's vision forward. It affected people's plans forward, and what have you. So, um, moving into tech leveraged fractional profit share was always in my mind, I guess, since the 90s, in terms of the rudimentary um, thought of having low barriers of entry rather than increasingly higher barriers of entry. And with all of these additional changes institutionally that were going on, it just seems like the best opportunity was to leverage tech even at that time, moving forward, and open it up to a global audience and a global partner investor scope and breadth.
What belief that you had it early on that time proved you wrong, like from your early career, something that you believed in?
Right. So I've always held the belief that uh, scale is very important. The ability to scale is very important. But to do it in such a way that you can remain healthy and not be, I guess, in an over leveraged position. That's also a challenging thing to deal with that a lot of owners have and continue to deal with. So I essentially originated and positioned Magnum to essentially uh, be a counter to a lot of these effects that are institutionally imposed. The barriers to entry in terms of profit share from a larger scale of property portfolio, um, and having additional asset classes for Magnum partners to go across, which we'll get into, I'm sure, um, that addresses all of these experiences in real world marketplace, and trying to attend to new generations that are coming up that really don't want to have, and I mean, I'm generalizing, but they really don't want to have the onus upon them in such a way that a lot of the older generation had gone into real estate investing and real estate ownership or any asset class ownership. It seems to me like the younger generations, the millennials, and now the Gen Z. Can't keep up with it, whether it's Gen Z or what the new letter is, but I think they want to be more uh, have more options. They want to leverage tech. They are very tech friendly, and they want to be able to have easy adoption into, in this case, fractional profit share, which enables them to be involved in a lot more activity in regions that they don't even live in, which are the highest growth regions, which we attend to, and the highest growth assets that we look to engage into. Um, so I think the younger generation has huge advantages moving forward, and if all of this was here when I was younger, I would have definitely been engaging this as a high leverage point to profit share, across many, many high growth assets.
Right, completely. So as you mentioned, things, are fast. Like, the younger generation, they want things to be fast and they're adopting AI. And we're talking about things being fast. So what slows a deal more today? Like, is it debt terms, permits, or data?
I think the DD on or due diligence on deals is, of course, a very laborious task. It's a necessary task, but I think when you're trying to piece together, for example, let's talk about. I always love talking about in real terms. If you're looking at a large scale residential tower, it has 200 units or 250 units or what have you. There's a lot of components to be involved in that acquisition. You've got to have your insurance people aligned. You've got to have your chosen lenders in mind. If it's a cash deal, then obviously that alleviates some of this. But you still have to have a lot of different stakeholders and players in play for you to close that deal. Those are the things that take a long time. It's not so much if you've been in the market, you kind of assess very quickly whether something's going to be worthy of pursuit and acquisition, and to be positioning it as a short, medium, or long term hold. And what point do you kind of foresee divesting this and moving on to other things? Or do you keep this as a generational asset moving forward? So, to answer your question, I think what takes the longest time is all of the components, necessary partners to put the deal together and close it. But um, the longer scenario is assessing how long you actually want to optimize this. Optimization is a long term strategy. It's not a short term play because you actually have to stay on top of each asset on an ongoing basis. So that would be the major long term aspects of it.
Where do you see people overpaying right now?
Overpaying, well, there's some land deals that are quite speculative in terms of anticipated what I call path of progress plays or density plays. Some people will speculate and overpay in terms of the density and the added value that they're playing into. They anticipate that that's going to engulf and accommodate and insulate their higher purchase price right now. And sometimes that's true. Sometimes it's not. Um, so I would say that in particular, sometimes the development lands fit into that profile. There's some high sort of trophy aspect properties that often get a surplus paid for. Again, there's typically a brand that will carry forward with that, or a operating brand. If you have a hotel residence combination property, they're often they often have a premium for the brand and for that acquisition moving forward as well. But then that's offset with when you look at doing something with it as well, because that inherent brand value carries forward and endures over time.
If rates, ease, what moves first? Pricing or like take up or the starts?
I think as rates move up, obviously it's going to have a uh, adverse effect on value because affordability to acquire is obviously going to be affected. So rates are a lever to a well bought property for sure. Um, and so that's why there's so much pressure to keep and lobbying to keep rates at a nominal rate or a reasonable rate, because as soon as it starts moving up and the base rate and all of the banks and whatnot that follow suit, even the trust companies, the A, B, C grade lenders, all follow suit, and whoever you're utilizing is going to be a much more costlier purchase because you're still sitting there with the existing revenue on that piece, but yet everything that's involved in acquiring that site and the carry is so much higher, but the revenue has remained static. So that's going to push the price down to make the numbers work. So yeah, it has a big effect. Rates are a big determining factor.
What do you think in UAE? What do global investors often miss?
Well, what they miss is you don't want to be too centric to your region, no matter how high growth it is, because then you tend to take your eyes off. And I would say that some people do this, a lot of people don't, because you have a pulse on a lot of different growth regions. You kind of have a feel and know what's going on in the North American market, and it sort of you drill down from macro to micro, and you have a feel for what's going on in terms of the like we just talked about the rates in those particular regions, um, or by country, what's going on in that particular state or province. Um, but I think the overall growth aspect of uh, those that have that mandate, you have to look at investments that are made in higher growth regions that are anticipated. They're very what I call fertile ground. There's a lot of velocity in those areas because a lot of places often go very static and non-growth oriented, um, and therefore it's going to affect growth. But when in fertile, high velocity regions that are growing and have plans, they have visionary plans that are in place, like 2030, 2050. So you know that they're inherently involved in planning that growth. They look out for their citizenry rather than looking at what they can take from their citizenry. It's a very different conversations, um, and very investor friendly environments that are all working towards developing a lot more master plan communities, a lot more commercial, um, industrial, a lot more office and land banking plays as well. So Magnum is pointed towards a lot of these regions, and for example, you have Riyadh that's coming up. You have places that are a little bit slower, but ramping up, like Oman, Bahrain. You've got, of course, UAE is very strong in a lot of segments, and they all want to be leaders, and they are leading in many domains. Yeah, as you see AI, you see a lot of tech-oriented leadership, you see a lot of real estate numbers that are just astounding, and a lot of that is just not cyclical. It's based upon a vision and a growth objective that's adhered to, and it becomes the mandate for everybody to accomplish. It's a very different environment than what a lot of people from North America, for example, are used to, because it's quite a different environment in that respect.
You're right. So as we mentioned about AI, and you talk about Magnum as well. So in simple words, what do people own in your model, and how do profits flow? Like, let's talk about your model.
Right. So it's essentially a mass partner investor platform, but also it's a mass social impact platform. I challenge the development team to essentially leverage fintech, wealth tech, and prop tech to do big things. And what we've accomplished is that we're able to provide high ROI growth back to Magnum's partners on a continual basis, distributed typically annually or semi-annually on growth investments. So what our partners essentially benefit from is fractional profit share, high growth return on all of Magnum's portfolio going forward. And that could be across many different assets, real world assets. And the social impact component really is an income empowerment component. So we're talking with a lot of sovereign wealth funds in Africa, the burgeoning behemoth of Africa, India, with a very large middle class coming forward with a lot of disposable revenue and income, that they're looking at what I call conscious impact capital. Not just capital for growth, but sovereigns, obviously, and investment authorities um, think in different terms. They don't always think for just profit only. It has to be a values aligned approach in terms of you have to invest in their regions to achieve master plan communities, development, community building. SMEs need to have an opportunity to, for example, come onto the Magnum platform and utilize the platform as their capital raise, um, where Magnum takes an equity position in thousands of businesses over time. Um, and that capital flows from Magnum's fractional profit share partners, and Magnum takes the position in business equities as well as mass real estate holdings, as well as all other asset channels. And then the uh, the partnership over time, much like Berkshire Hathaway was many years ago, in terms of when Buffett and Munger were essentially took an original textile company in that case and built it into a limited partner, exclusive partnership group that invested in business equities over time, and then it was sort of an archaic model with no innovative um, tech or leverageable tech that or social impact component. There's many other aspects that Magnum brings forward, but in terms of comparative, I would say that the large scale return that comes back to partners, investors in Berkshire Hathaway is often an archaic model of what Magnum is bringing forward to much larger global scale and much wider asset class across the entire portfolio. So we're also implementing Sukuk, which is um, in terms of fractional profit share, it's called Murabaha. It refers to an Islamic Sharia compliant finance product. where Magnum partners and investors buy a fractional profit share of a sukuk or an Islamic bond that is based upon a cost plus profit smart contract. Fractional sukuk allows smaller placements. It aligns well with Magnum's tokenized low barrier to entry. Um, while fixed profit share is derived from economic activity rather than just for the sake of interest alone. That's a very necessary component. Um, so they would benefit from the sale of the Magnum's global portfolio over time, uh, just ensuring that it's based on real economic activity and not just for the sake of just sheer interest. So Sukuk is going to be a big or is a big aspect of our investment asset class for our global partners. And I was just touching on sovereign wealth funds and investment authorities. Now, the vision of their particular capital placement has to benefit their citizenry, and we're very well aligned for that. Um, because we would have vested developments, master plan communities, help the SMEs actually be visible and become aware on the global stage, and help those businesses grow, which helps the tax base of the municipality, which helps communities build. And so the real promise of areas like Africa and India and Philippines, Malaysia, Indonesia, a lot of regions that essentially have not had a mechanized fintech solution to achieve the necessary things where the rubber meets the road. That's where Magnum is poised. That's where Magnum will flourish. And that's an ecosystem that benefits everyone in a win-win-win. And that fits exactly what I wanted to bring forward.
Why profit share instead of a normal dividend?
Right. So profit share enables a different aspect versus fractional ownership. You can have, and it speaks specifically to this aspect. If you have fractional profit share from a global portfolio, you have no exposure to single asset downside risk. Your your benefits are across many different asset classes in terms of a global portfolio. If you're only looking at fractional ownership, it's a much different scenario in terms of 1,000 or 1,200 or 1,500 people owning a small fractional piece of an apartment, which have been other models that have come forward. That really never interested me because even as a partner or investor, I would want to not have exposure to the single asset downside risk potentials. I would rather be spread across many asset classes that are high growth oriented, if we're only talking about return only. So I look at it by putting myself into the position of would I want to be one of 1,500 or 3,000 fractional and ownership players in a low value single asset apartment or single asset. So I never was interested in the fractional ownership solution that has come forward as well. Fractional profit share enables global investors and global partners, sovereign funds, etc., from individual to institutional, to actually have a play in a growing portfolio, growing global portfolio that mitigates risk and downside and optimizes upside.
So how are developers reacting to it? How they're responding to your model?
Yeah, I think, for example, I'll give you a live example. I mean, we had a bank connect with us from New York, actually. And they were after pre-construction financing on projects. And we thought that, okay, well, let's look at this because our Magnum's investments into business equities from in terms of capital raise and what that founder or executive team is essentially offering for that capital raise might be 20% of their of their company or what have you. So Magnum would position as the equity owner of that company. We said, well, we can make the same thing happen for projects. So the conversation went to this New York bank. Essentially, we're looking at how can we position for capital raise. This particular entity wanted to have pre-construction financing in play where eventually when they got construction financing, it would essentially pay out and move forward to development. So we looked at that and said, well, that's very interesting. We can treat that just like a business and just essentially incorporate it as a project. So essentially we're both project and business equities oriented. So we would take a position play in that project until it got to a point where there was a payout or there was an acquisition or construction financing achieved where there would be a refi. and the profit share would then flow to all of the partners for all Magnum partners. So that is well incorporated. So when you ask about how developers are looking at this, I would say that our live experience is very positive because they see that through fractional profit share, and you have a wider investor partner base to allocate capital, and Magnum takes the position for this. It's all very straightforward. Um, and it works. It's a business equity or project oriented solution to developers that are looking to raise capital in a different way instead of perhaps bank financing or conventional lending.
So there must be resistance. Like, what proof do the developers ask before they get into business with you?
Well, they essentially want to ensure that you're well positioned within a large scale kind of investment community, of course, which we are. We're in one of the most investor friendly, investor conscious capital pool environments that you can think of on earth. And a lot of those entities, high net worth individuals, family offices, sovereign funds, etc., straight from individual to institutional, as I call it, are looking for values aligned capital growth, and they're open to projects that make sense, and they're open to projects that essentially have run into some sort of perhaps some stumbling block, or they have an alternative form of investment that they want to be open to, and we have uh, we have connectivity to ensure that that match is made and that the capital flows and the deals flow.
Right. So what kind of partner do you need more of right now and why?
Well, Magnum was always originated on the concept that it would be um, a low barrier to entry, and it would serve the needs of the global individual right up to institutional. So I would say on a perpetual basis, any of those profiles, all of our investor profiles or partner profiles um, are across the entire demographic and will continue to be. So Magnum's positioned as a perpetual um, capital capital play, but it's also a perpetual social impact and income empowerment play at the same time. So it's an ecosystem which also involves capital raise for business equities that empowers and encourages SMEs to do better, and also gives partners the fractional return in terms of profit share on a continued basis. So it's an ecosystem that has been specifically engineered, and it's one that works.
So how does where does tech help you today? Like in your model, like AI.
Tech's a very integral part. As I mentioned, we're levering tech to do big things, from conventional real estate all the way up to Sukuk certificates, through to precious metals, through to other investment classes. Now, Magnum is also incorporating what's called a super app. This super app will have AI empowered behavioral content in it. And what I mean by that is the super app will have individual apps that'll apply to every asset class within our environment, within our ecosystem. So, what it does is it's a loyalty builder. It's also a convenience builder in terms of having um, uh, the Magnum partners essentially be able to go from one asset class to another, kind of look at this, look what companies are looking to raise capital. What about this asset class? How about on the real estate? We want to invest there. So it's an ecosystem which is also going to be suggestive from AI's point of view in terms of, is that investor inclined and well positioned to be suggested to also invest over here? Is it also a suggestible, reasonable for that particular partner to consider investing over here in this asset class? So we're integrating AI in the super app across all of the asset classes where separate apps will be integrated. And each developer, for example, out here, whether it's Asia, of course, MENA, EMEA, Europe, Asia, North America. So the intention is to have um, apps for within the super app apply to each developer. So there's a lot of co-branding. There's a lot of increased sales of units for each developer, because then you also have more capital flow for that particular developer. And all of a sudden, our linkages and our connectivity and co-branding is driving a lot of Magnum capital to acquire uh, bulk bulk product for each developer in the product sales that they're looking to optimize. So there's a lot of synergy there. And so we look to have a separate app within the super app for every major developer, and that includes North America as well.
So where has tech not helped you yet? What's missing?
You know, I honestly, as long as you can log in and you can log out, I think it's it's a frustration that is really mitigated by all that it can do. I think the rudimentary frustrations of tech are going to be there on a continual basis, but everybody usually irons that out pretty easily. It's the big things. It's the big solutions that are developed that actually assist in making what you want to have happen. So tech is a big enabler. It can move rudimentary functions and conventional real estate into a very forward forecast of much more efficient, effective benefit and profit share benefit, and a better way to own. So it's an enabler in many ways. So I don't see a lot of tech frustration coming forward, unless it's very rudimentary and small. But tech is meant to be integrated to do big things if you're so inclined to do so, and I'm a founder that's so inclined to do so.
So I hear this a lot. Like people talk about tech will replace them. Tech will take their AI will take their job. So what's your take on that?
I don't think, well, there will be some aspects where suggestive learning will result in a lot of consultative work that's perhaps going to be impacted, consultative work, things of that nature where AI will definitely have an impact. But I think on a large scale, I think human intervention into managing what AI's output is or managing what AI's functionality or driven purpose is. Also, you'll never be able to replace, as far as we know, I guess you can play this back in 50 years and maybe I'll be outdated by then, but behavioral components, uh, yeah, empathy, things that are more human relations oriented, I don't think are going to be replaced very quickly. And because of that, a lot of those components cannot be infused into what AI is given the task to do. Therefore, human governance always needs to be in play, and so I don't see it as being a wholesale change. I just see it as affecting certain spots.
What is one AI used in real estate you would pause for now?
Well, I would say that real estate tends to come down to um, a lot of experience-based decision making, and everybody has their own subjective approach. It's not a standardized thing. It's not generalized. You can't have AI kind of dictate, that, oh wow, this, because of all of its analysis, that this is the one asset out of five that should be pursued because of XYZ. I mean, there are still some subjective components that go into conventional real estate assessment and analysis. um, but having said that, there are a lot of aspects that it can analyze and come through with suggestive um, output that may make sense and take you down a road of a particular direction of maybe these two versus these two, or a 2 out of 10 of these seem to fit the parameter. So I can see that it may augment decision making, but there's still a lot of human relations, human factors, engineering, and behavior, human behavior that needs to come into play because it's largely experience based, and every individual has a different, or every entity as well, has a different mandate in terms of what they're trying to achieve. AI can't always, engage in that particular realm. So it still comes down to human involvement in a big way all the time.
So what do you think what skill pays back the fastest in this market?
Sorry, which skill base?
So what skill pays back the fastest in this market?
Oh, pays back. Okay, I think if you are an effective, um, uh, I call it an asset visionary. See what people don't see. That's going to provide the biggest return always. And that's cross industry, that's across many domains. But given that we're just talking about real estate, uh, you have to assess, be confident in what you see that others don't see, and how you're going to make that a reality in terms of its best use. How are you going to position its rezoning to be what you see in terms of density? What's the upside in terms of that particular play? What's that going to involve? How long of a period is that going to take? What's my holding cost, et cetera? And what's the ROI at the end of the day? I think the skills that are going to endure are the analytical skills that are needed. Everybody kind of looks at real estate in a very sort of 30,000 foot level and I think what's forgotten is it's a very analytical play. You have to have the skills that are from financial to right down to gut feeling, right down to locational analysis, right down to rental projections, including, how does rental location affect future tenancy? What values can be optimized here? What kind of industry base is strong? It's going to maybe draw jobs over into this different region, which may affect rental values and rental retention in this particular market. So there's a lot of interrelational play and analysis that goes on. So I would say all of the skills that have been critical in the past will continue to remain critical into the future. I think there just might be more suggestive AI um, based on certain parameters, AI infused suggestions in terms of what is optimally considered in terms of an acquisition target. Um, all of the accounting stuff obviously will be um, a very heavy AI integrated. A lot of that particular numbers crunching and what have you, but I think when you're governing your mandate in terms of what you're trying to do with a particular asset or a series of assets for your particular reasons, that's going to have to be the individual. It has to be a human being.
Perfect. So, what is one mistake you would tell a young asset manager to avoid?
Well, I would say that if it's a larger portfolio, I would say don't just get fixated on one aspect of a very few number of properties. You have to apply the same benchmarks across your entire portfolio, whether that's small or large. Have the same expectations of the changes. Be ROI positive, but also be NOI positive. So you're operationally enhancing um, each particular asset on the best capabilities that each one can possibly have, and then you'll be able to focus on the most positive outcomes and valuations that you're able to achieve over time.
If you were 25 and you have to start all over again, how would you do it differently?
Well, I would take advantage of a lot of the highly leveraged. We talk about leverage a lot in real estate, and I would have to say that leverage attains a lot of gains through the conventional means, but now with the implementation of tech and fractional, I think your leverage ability into all of the upside of asset profit generation is a whole different picture now. Um, if I was 20 plus right now, I would look at what scales my investment dollar in the most effective growth oriented aspects or asset classes. Um, and is there a dilution of risk employed within it? And if I'm so inclined to be um, such that I actually care about more than just money, that I actually feel good about vested capital with impact employed into the entire system as well. So I think if I was a younger, all of these things would come into play. It comes down to the individual, though. We all have our own individual level of importance in terms of if you're only profit driven, if profit's your only motive, then it's going to take you down one path. Um, but something that accomplishes all of your goals is really the direction you want to go. So, um, yeah, so I think I would probably stay within the same realms that I'm currently in now. I would just have more leverage of time to effectively achieve a lot of those goals. But when you're building a legacy driven, globally oriented business, you're able to make certain choices and design and engineer and engage your development team to dive deep into what I call the social, the base of the social economic pyramid, and not just have the mid and upper class benefit in terms of the rich just becoming even more wealthier and having mechanisms in place to do that, but dive deeper into the masses, dive deeper into enabling more leverageable wealth building and involvement and participation into, for example, what Magnum does on purpose. We're drilling down deep into the economic base of the pyramid, and when we do that, um, that's where the masses are. That's where mass empowerment needs to happen, but it's also where the mass capital exists. So I would probably be doing venture to be doing exactly what I'm doing now and come through the same path. So I'm fortunate to be able to say that.
Great. So, what's one advice you would give to a newcomer, like who's just starting out in real estate?
If you're just starting in real estate, I would say that your your cost factor is going to be very high. Try and keep um, your anticipated cash flow in terms of your gross rental revenue. I'm just talking about revenue-oriented properties here. Um, keep your rental revenue forecasts realistic in terms of what you can achieve in your rental market, and align your costs as optimally as you can, and you'll always have high performance from that particular asset. Um, things are much more expensive now, so you're going to need more effective levers to get into deals, more partners to get into deals, whereas before things could be done individually or with one or two people. Now it's involving um, more leverageable capital, and fractional fits right into this particular future of investing very well. And I would encourage people not to be dismayed by the high price of individual assets, because there are solutions and ways around to benefit from these asset classes without feeling like you have to wait till you're 50 years old in order to be able to buy your first place. There are mechanisms and deal structures that can be done. There are things in play that are enabling technology to enable your involvement and participation, to be involved, and you have the benefit of time um, to benefit from these things.
Canada roots or Dubai hustle? Which shaped you more?
Canada roots, and Dubai fertility and velocity.
Okay. Ranch life, grit or boardroom polish? What wins on a hot day?
Ranching roots, but having the bandwidth to also be very effective in the boardroom as well. So you have to be extremely adaptable. But your work ethic stems from who you were, who you have been, and in most people, well, I guess most people that I know, who you were never leaves you. And that will be expressed in your work ethic, and that will be expressed in your values forward, and that gets expressed in the boardroom as well.
Great. One habit you still use from early career?
I often talk about my rear view mirror. Um, this is something that never leaves me. Um, we go through life, and some people have it and some people don't. Always called it my rear view mirror in terms of the car analogy. So I always look back in terms of what I feel my forefathers and foremothers, all the people that actually took a lot of life and death risk back in the early 1900s to come from an entirely different country, risk all, risk everything. And I call it Harry 1.0. And that's when the originating grandmother came here in 1900, and went through all the trials and tribulation to establish, and never gave up cultural their cultural identity or what have you, even though immense pressures were there to do so. Um, I have a big rear view mirror in terms of asking myself, is what I'm doing and what I'm creating and what I'm putting forward in line with what their values aligned mentality and dreams and vision were back then, that they just didn't have the time to continue with. So one habit that I would say, that's one main habit that never leaves me, and I'm very, very um, attentive to it on a continual basis. And I really do think it affects every decision that I deal with. Um, and achieving the vision on a continual basis, so that it's actually a legacy driven, values aligned, future focused endeavor in terms of whatever you're doing. So that would always be my main habit that I stick with me no matter what.
What keeps you calm during your toughest situations?
I would say that remembering that tomorrow is another day, and remembering that today might be tough, but put it into context. Um, I always say that you're not in the most toughest environment. For example, there are people living in various aspects of the world that are actually going through the toughest environment on a day-to-day basis, in every aspect of their life. And you may be just dealing with a tough business decision, or you might be just dealing with a tough scenario or a challenging state of circumstances. It doesn't even equate to what people deal with on a daily basis in some areas of our world. And so I'm also very reflective, and I put things into perspective a lot. When you do that, um, big things at the moment become very small. Uh, and you put it into perspective, and you really think that, okay, well, you know what, this isn't such a big deal after all, and there will be a resolution or a solution to it, and let's press forward because it's not that big of a deal in the overall scope of things. Yeah.
Great. So fastest way you have lifted NOI in 12 months.
Hmm. So the fastest way was essentially being able to effectively turn over an entire building within a 3 month notice paradigm. Lease up was about 1 month, 75 to 100% gross rental increase, translated into that asset converting valuation increase of about 180 to 200% within a 6 month period, just based on NOI numbers and valuation in terms of uh, cap rate, cap rate valuation. Yeah.
Red flag you spot in 10 seconds on a deal.
Mm. I would have to say when they're not speaking to what the future area plans for rezoning are in that particular area, when there's been no reference in terms of what the future forecast for a particular zone or what have you. Not so much it can be actually a very much a green flag as well. So it just really depends on the information. But purposely um, leaving certain pieces of information out when you're putting all of the parameters of a particular property forward. Um, you always have to watch out, and always ask the right questions and kind of get a full picture. Um, because your environmentals are going to come up in terms of the past of this particular site. Was it a gas station? Was it a refinery? Was it something else that has environmental concerns? We had issues where there was a gas station and underground. All of these kind of fuel flow came and affected whole neighborhoods. This thing was there for about 80 years, and there's been all this kind of environmental challenges that have now permeated into affecting many different areas that are downslope from it. So a lot of things like the past scenario can affect that should be spoken to. So always look for that. The present and best use zoning and densities, but also what's forthcoming in this particular region, what's coming forward here. If it's all positive, then people are usually, and agents and whatnot are usually particularly positive about providing that information. But if it's specifically neglected, then perhaps the future of this particular area is being not discussed for a particular reason. So always make sure that you know what the future use and the future plans are for that particular sub region and a more macro region as well. It will point to a lot of margin growth. So it matters because a lot of our investor partner base and a large part of the world essentially looks for Sharia compliant essentially halal based funds to allocate, and they want to be involved in projects and uh, activities that are not just solely based on interest creation. There actually has to be some underlying economic activity and impact that is occurring. And I see this as a very much wider application of what people see in their desire to be involved with conscious capital, with impact and purpose based capital provision. So I don't see it as a faith-based aspect or what have you. I just see that it's actually a cross-cultural benefit to look at things in through this lens. You want to have capital engaged to have economic activity and impact. Bottom line, I think you have to be a more purposeful investor. You have to be a more purposeful, engaged citizen, a global citizen. So I think it all speaks to that, no matter what background you're from.
Perfect. So data you check first thing in the morning.
The data I check
Yeah, first thing in the morning. You wake up.
first thing in the morning is if my kids in university are doing okay. And my kids out in the work world, if they're doing okay. So I'm very family based. So in terms of data, that's probably the most important data I can set my day off well with. Uh, yeah. So family is very key. Family is very important. These are key aspects of one's life that again, we talked earlier about that backboard that you use when tough things come up. That's a major backboard there. So that, I mean, you put things into relation of, is everything okay there? And they're all right and everything. And If that's a big check mark and it's a big yes, then there's nothing that you're going to face in the day that's going to be that major.
Very well said. So one place tech truly saves you time last quarter.
I think efficiency of information, bandwidth of information. Obviously, decision making is made on good information. So I think that's the key is provision of information and the scope of it and the accuracy are all very important because they form all of the basis for effective decision making. Absolutely.
So last but not least, just complete the sentence. In 5 years, everyone will realize.
In 5 years, everyone will realize that fractional profit share is a very well leverageable aspect when it's tech enabled to benefit the masses.
Perfect. Great. Jason, it was lovely to have you here. Like I had a great conversation with you. It was fun talking to you, listening to you, things you have said. Before we end our conversation, where can people reach out to you if somebody wants to reach out?
Yeah, so we've got, if you're interested in being a partner of Magnum moving forward, we have an email address of Capital Partners with an S at magnumequities.com. If you are interested in being an engaged capital agent, which is a facilitator or introducer of capital to Magnum, we have an email set up at capitalagents at magnumequities.com. And for general questions, it's info at magnumequities.com, and we'll do our best to get back to you.
Great. And also reach out to him on LinkedIn as well. He responds very fast.
It's very important out here in this world, in the Middle East and Asia and all of the Asiatic countries. I mean, it's a very looked to and powerful communication tool. So we definitely have to be quite active and responsive in that as well.
True. Thank you so much, Jason. Thank you for being on my show. It was great to have you. And maybe in the future, we might have another session. You never know. Thank you so much.
That would be lovely. Thank you very much, Hashem. I appreciate it.
Great. Thank you so much. This is Real Talk. See you next time.